Hello everyone, and welcome back to the final video of the How to Write a Business Plan series. This video aims to analyze the most important part of your plan, the financial plan. The financial plan is also the hardest part of any business plan, as it includes a huge amount of detail and it needs to be really accurate. Any financial plan requires 6 aspects: a startup plan, an income statement, pricing and revenue projections, a cash flow statement, a balance sheet, and finally, a break-even point or a return on investment analysis. First things first, the startup plan. The startup plan basically analyzes the total cost that an investor or yourself as a founder will need to invest in your company in order to start these operations. In the startup plan, you need to be very detailed and it needs to be based on the area summary and the whole part 2, which is the company analysis. The more detailed your company analysis was, the easier your job will be in indicating the startup costs. To indicate the startup costs, you need to think about things like permits, licenses, building costs, labor, pre-opening payroll, even grand opening costs, legal fees, anything you can imagine. Now your question would be, how do I find all this information? Well, as I myself experienced this, you need to really go into depth and go outside of your comfort zone to really get information from experts, go to the municipality and ask professionals, ask your family members if they know someone, for example, a real estate owner, an architect, a manager in a business that is related to the business you want to open, and then you really come in with a plan about how much the business will cost you. Then we come to the pricing. The pricing basically indicates the revenue projections. A good number to always take into account, as we said before, is 3 or more years for any projections or data. The revenue would be about all the services and products that you will offer. So let's say if you're opening a hotel, you need to indicate what types of rooms you're offering and why are you pricing them, and reasoning based on your industry analysis. So if you have a really detailed industry analysis, you can really say, okay, this is the ADR for these stars, for this size of room, compared to also your competition and the competitive analysis. Therefore, as you can see, every part of the financial plan is linked to the parts that you previously wrote. Therefore, the more detailed those parts are, the easier your job will be in the financial plan. Therefore, I would suggest you, if you feel uncomfortable with this, to purchase the Student Investor Business Plan example using the link below. It only costs you 30 euros and it's very detailed, and the financial plan is more than 15 pages long. Therefore, I really believe it's a huge amount of help. And then, now that we have the revenue, we move on to the income statement. The income statement basically deducts all the costs from the revenue you just calculated. At the beginning, you need to deduct the cost of sales, ending up to the gross profit. The cost of sales usually is a percentage. So let's say you're opening a restaurant, you say that you are operating with a 20% food cost percentage, so you just deduct it. So if your revenue is 100,000, you deduct 20%, which is 20,000, you have a gross profit of 80,000. And then you need to deduct all your variable costs. For example, any commissions you will have, for example, a hotel or an online agency, you have commissions. So you need to deduct those, you need to deduct any value-added tax, marketing, and these kind of things. And then you come to the income before fixed charges. The fixed charges would be things like rent or accounting fees, legal fees. If you have a fixed utility payment, if your payroll is fixed, then those are fixed costs. And then you come to the income before taxes. Let's say your taxes are 20% and your income before taxes is, let's say, 50,000. So you need to pay 10,000 in taxes. So your net income is 40,000 euros if your currency is euros. And then the next step would be the cash flow or the balance sheet. You can to either of them, I would suggest you to start with the statement of cash flows. A statement of cash flows has three sections: operating activities, financing activities, and investing activities. Investing activities would be if you invest in something as a business, or if something is invested in your business from your side or from an outside investor. And then operating activities would be, let's say, your net income or your loss. Also things like depreciation and amortization. Then you have your financing activities, which are basically debt or dividends declared. And then we have the balance sheet. The balance sheet includes three parts: assets, liabilities, and equity. The equation for balance sheet is assets equals liabilities plus the equity. The assets and the liabilities can be split into current and non-current. A non-current asset would be something that can be converted to cash within 12 months. And then liability that is non-current is a liability that can be, let's say, covered or settled within 12 months. Anything that is not covered in 12 months or converted to cash within 12 months is a long-term liability or a long-term asset. And then the equity basically explains the stocks that your shareholders own, any treasury stock, which is a contra account, and then also the retained earnings. So, for example, the retained earnings would be the income minus any dividends that are declared from your shareholders, and then you have your retained earnings. Some businesses retain some earnings because they want to use it for, let's say, maintenance or renovation. So not always you keep all the income. Sometimes you leave some of it for these kind of things, renovations, maintenance, or maybe you want to invest in something. And then we move on to the final part, which is your break-even point, or preferably a return on investment analysis. Most people think that you need a break-even point in a business plan. However, a break-even point analysis only takes into account variable costs, fixed costs, and your projected income. However, it doesn't take into account your startup costs. Therefore, for a business that's already running, a break-even analysis is perfect. But then, if you want to add the startup costs, you need to show the return on investment, not the break-even point. And it will also show when you break even towards your investment. So return on investment analysis is quite simple. You just make a table saying your startup cost, let's say it's 10 million US dollars, and then your business makes $1 million a year. So if you're gonna, all your income will be given to your shareholders. So in 10 years, you return the investment. And then you need to show every year what percentage is covered. So let's say you want to turn back to the second part of the plan that we talked in our first video and the ownership summary. These are intertwined with each other. So now you have your return on investment analysis, and then you want to show to your investor how much are you giving him and when are you returning the money. So let's say you plan to return a 200% return, so the money plus 100%. So if the investor gave you 10 million, let's say you want to give back 200%, you will give 20 million. And then you need to consider what percentage you're giving. If you have a capitalization rate of 10% and the investment was 10 million, then you need to think about giving a higher percentage of the company. Now, if you're starting a tech business and you have a quick return, let's say within 5 years you're returning 300 to 500%, then you can give a lower percentage. Let's say for a 10 million and you evaluate your company to, 100 million after 5 years, then you will, let's say, give the investor a 20% stake, which is 20 million already, and then you give a return of 300%. Then the investor basically returns 4 or 5 times his stake, and then he also has the shares. So he'll be having a steady income in the following years, and hopefully that income will be growing. I hope that you enjoyed this series, and I hope that you will use all this information for one of your own plans or even multiple. And I would suggest you to hit the subscribe button and the alert icon for future video notifications. And of course, join our student investor website by joining our mailing list and reading our blog. Thank you very much.